Hello traders, Gary Wagner here. It is 11:39 in Honolulu and 5:39 in New York on Tuesday, 6th day of September 2022, and this is the daily report for gold and silver. Gold continues to struggle even after Friday's respectable upside move. It gave most of that back today, with the December contract currently down $9.70 and fixed at $1,712.90. We did send out a trade alert this morning with an extremely tight stop of $7. We were hoping that the piercing line identified on Friday would actually have follow through. That was incorrect. We were stopped out for a loss of $700. In terms of the rationale behind gold continuing to struggle at current pricing, we've got to look at the dollar index because the dollar is closing at an all-time record high. When you compare it to recent activity, you still have to go back 20 years or so. The dollar index has broken above 110. Currently, it is up 0.65% and fixed at 110.22. Silver did have a fractional gain today, moving up almost 3 cents, with the September contract of silver currently fixed at $17.91. If you look at today's activity, it actually did trade to a pretty respectable high, 1846, but struggled and could not hold on to those gains. As you can see, we've got a doji candle at this point with a slight downtick bias in terms of its open and current pricing. It is quite clear that the dollar is strong and continues to gain strength over time. It is exactly the opposite of what we're seeing in gold. In the dollar, we can look at series of lows, and they have consistently been higher lows as the dollar's moved up over this last year and a half, as well as a series of higher highs. That, traders, is the definition of a bullish market. It confirms it. The second thing is the series of moving averages from 50, 100, and 200-day moving averages in perfect bullish alignment. Perfect bullish alignment has the shortest term on top, followed by the 100-day below that, and the 200-day below that. Also, when we pull up a longer-term chart, we'll see that we are in new territory that we haven't seen now in about 21 years. But the fact of the matter is we had a tentative top at approximately 109. You can see this top here, as well as a series of days in which it consolidated at this price area before surging higher, breaking and closing above 110 on the dollar index. It is also clear that it is a series of fundamental events that are occurring which has given the dollar its upward momentum, specifically the Federal Reserve's hawkish monetary policy to attempt to reduce inflation by raising interest rates. When we look at a very, very long-term study of the dollar, as we've done before, we can see that 110 is an area that we haven't seen, yes, in 20 years, but more importantly, we have no substantial top or bottom in this particular price point. It's on the way up to 120 and then on the way down. If we go back further, there is no historical point in time when we had the dollar index as strong as related to a basket of currencies at 120. And as I said, that occurred about 21 years ago. And considering that the Federal Reserve began its first step to tighten their monetary policy with the first interest rate hike in March, which is the same time that gold made a second attempt and came close to the all-time record high, just $10 shy, with this high coming in at $2,077, we can see that we've had a series of lower highs as well as a series of lower lows. And that, traders, is the absolute definition of a bearish market. When we look at our moving averages, we are now in full bearish alignment. with the lowest value being the shortest term or 50-day. That is followed by the 100-day, as well as the 200-day, which rests above it. And that is why we continue to see gold struggle. In terms of what we want to look at as critical price points, 1700 is extremely important, but 1700 is also related, as we talked about in numerous articles last week, to $1,680, because when we look at historical data, we've seen gold break below 1700, but in the recent history, always seem to maintain a price point above $1,680, which is why I consider it to be a key and critical level of support, which is why I remain cautiously optimistic about the potential that gold could in fact hold this level of $1,680, because historically speaking, it has really served as a level of support on multiple occasions since 2020. However, that cautious optimism has to be tempered with a stark realization that a break below 1680 on a closing basis could have severe consequences on a technical nature, because in terms of levels of support, there really isn't any strong level till just below 1500 on a technical basis. And for that reason, I believe that this particular area, 1680, is a line in the sand. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.